Good morning and welcome to our conversation. In today's conversation, we have Mr. Ankit Kanodia, who is a co-founder of a wealth management and investment advisory firm. He's an MBA and have a huge experience in advising the investment investors, small and large. Good morning, Mr. Kanodia.
Good morning, Ramana sir. Thank you so much for having me here.
That's great. I'm very happy that you could take time out to join us. And today we are going to pick up one particular issue, which often small investors keep on asking us, is about this particular accounting concept called equity or net worth or shareholders fund. But before I ask you questions on that, I would like to know from you as an investment advisor, do you think that investors look at the financial statements?
Sure, sir. So I would believe, and I strongly believe, that any serious investor must look at financial statements. So there are a lot of retail investors who invest in the market as a hobby. They may not look at the financial statement, but anyone who seriously wants to make money, generate wealth rather, over the long term in the market, they must look at financial statements, unless you are a completely technical analyst who only looks at price charts.
That's great. And Ankit, can you briefly tell us about the type of the clients or the people with whom we interact? Because that will also help us to understand the type of the advice you're going to have for our audience also.
Sure, sir. So I have clients from one spectrum to completely the other spectrum. So we cater to new investors, retail investors in our learning platform, Mission Smile, where we teach them through our research and also through the research of all our friends and peers in the industry. In fact, we call stalwarts of the investing community who have 20, 30 years of experience in investing. So this is one kind of investors we cater to through our learning platform. And then we have some really wealthy clients who have net worth in excess of 50 crores, sometimes in excess of even 100 crores, who wants us to manage or advise them on a small part of that, maybe something like a crore or maybe sometimes 5 crore or 10 crore. So these two are the broad range of people whom we interact with and advise.
Oh, that's wonderful. So you have the entire length of the gamut of investors in your portfolio. But what is your take on what is the right age for anybody to get into markets? College level, school level, what do you think?
That's a very, very, very good question. And in fact, one of my favorite question and topic, which we keep discussing amongst our friends. So I believe stock market is one area, or investing is one area where age is no barrier. So I would say someone who has little understanding of basic understanding of finance or accounts, or even if he doesn't have, say, 9-10 is the time when accounts gets introduced in commerce section.
Right.
So those people are anyways going to be very okay with studying the financial statements and understanding them. Even if you are from a science background, and if you can understand, because I've seen many investors who have been from science background, engineer, doctors, who are doing exceedingly well in the market because they have the curiosity to learn. So accounting is just a language.
Yeah.
And I remember attending your class at ExaMB in 2007 and 9. The beautiful way in which you explained how to understand accounts. So, and the simplicity with which you explained, that is what is required for any investor. You have to simply understand how the money is coming in and how the money is going out. And even if you don't have any experience in accounting, you can pick that up as you go along. So
Cool.
I would say someone at the age of 14 to 16 can still start if he is curious. Unless he is not curious, I would not force him to go. But 14
Okay.
to 16 is a place where you can start looking at it. And maybe by the age of 18 to 20, you can be a very serious investor.
That's wonderful. That's quite encouraging. So, based on your experience, do you think that investing in a market is a science or is an art?
So let me give a disclaimer. When I entered the market, say 10, 12 years ago, I thought it was more of a science. And today, if you ask me today, I would say it is more of an art. So
Okay.
maybe 10 years down the line, my view may change as I evolve and as I see market through a different lens. But I believe there is both. You
Okay.
must have some science. So what do I mean by science? You must understand how businesses work. You must understand how financial statements look like. What are some really important concepts like return on equity, book value, sales, uh, uh, price to earning ratio, all these things. These are some basic things which you must understand. Management, again, that is also, so management is where there is a lot of art and science comes in. So management will never give you everything clearly. So it is not scientific to understand what is the management, but you have to use your softer aspects to understand whether the management is going in the right way or wrong. So that is where I believe art and science both is there. Today, I would say it is more art because
Okay.
investing and business is filled with uncertainty. The more you can bet on the management, the
Okay.
better long-term prospect it is for you and your investment. And that is where art comes in.
That's wonderful. Before we shift our focus to specifically on equity, do you think that it is necessary for an investor, small or a large, young or old, always to fall back on a specialized advisor like you, or they can enter the market on their own?
Sir, with a disclaimer that it's almost like asking a barber, do you need a haircut or not? A barber will always say yes, but I'll try to be very honest with you on this because we are having this discussion for students and it is very important for them. I believe 90% of investing and your personal finance doesn't need financial advisor. So if you are someone who can and who is willing to learn, 90 to 95% of times you don't actually need an advisor. Even though I am an advisor, I'm telling you that. So why you don't need? Because ultimately personal finance starts with some basic habits of saving well, earning, focusing on your skills and earning well. People talk too much about alternate source of earnings and how to do investing. But first of all, the most important part, which generally gets uh, not noticed as much as it should be, is you have to first find out what is your skill, which you can sell and earn well on, and over a period of time improve a lot on it. That is the most important part. If you can do that, and if you can have reasonable basic habits of high saving and then putting that saving into investment, even if you start with something like, say, an index fund investment, even that is fine. 90% of the work is about knowing yourself, what skill you need, and earning well through that. People look after so many other things. Once you do that, whether you want to go with investing in index funds or you want to understand how to invest in market, that comes at a much later stage. And even there, I believe a curious person, there are a lot of information available on the internet for free. You can, over a period of time, understand that. However, I'll just put one disclaimer here that investing is not for everyone. So over a period of time, you may realize, say 6 months to 1 year, a young person gives to investing and he might realize that, okay, I don't find this interesting enough and it is too difficult or too technical for me. he or she should be the one who should be going for a
Advice.
financial advisor.
Well, that's quite encouraging. I'm sure that this is coming from a professional advisor, that someone can start getting into the market on their own is quite encouraging, Ankit. Uh, Long time back, maybe some time back, we went through a very detailed note that you had prepared, and we shared with our students on equity, understanding equity. Yeah, and that was a very comprehensive note, and we got quite positive feedback on that. Very nicely, you explained the relevance of equity, relevance of book value. So, therefore, what we would like to do in the rest of our time, we would like to understand the concept of equity and book value through the lens of an investor or an advisor like you. Can you take us through the understanding? What do you think about the term equity? Where is that item visible on the balance sheet?
Sure, sir. So, first of all, before going into balance sheet and talking about equity from the balance sheet perspective or from a financial statements perspective, I want to put it very simply, like what I learned from my father and my uncle when they used to do business. And I'm talking about 20-25 years back, where cash was the only mode of accounting. It was a cash accounting system. So equity, in a sense, the best way to understand that is if you go to a banya and ask him about equity, he might not be able to tell you what is equity, but he will give you a very good understanding of equity, which you can apply in any course of life. And that equity, according to me, is the punji. In the Hindi terms, we use the punji. That is your equity. Okay. That you have put in the business. Okay. That is your own punji, which you have put in the business. That is called equity. And this punji, again, go back to the cash accounting system, and if go for a look at a banya who has a small shop, he will say that I put in 5 lakh rupees of my own personal money into this business. And over a period of time, through my trades, whatever I sold, I accumulated more cash on it. Today, that 5 lakh over a period of 2 years has become 10 lakh. That is my equity. He might not use the term equity, but that is what is equity. Now, using that example, I'll come to the financial statement. When you look at any financial statement, you see equity, you see first of all share capital, and then you see reserves. So what is that share capital? That share capital is the initial punji that Bania put, that 5 lakh rupees.
Yes.
Okay? And over a period of time, that reserves get accumulated through profits, right? That is what I would say in a very simple manner what an equity is.
Okay, that's right. So, but when you see a balance sheet of big companies like Tata Steel or TCS or Infosys, and would like to understand the company through the lens of equity, do you get into the composition of equity? What exactly equity consists of? Can you throw some light on any company or anything which comes to your mind?
Right. So again, that's a very, very, very important question, sir. And I would just share that one way of looking at equity is what I've already showed. The other way is, see, balance sheet is always, we use the matching concept or the double entry system in accounting, where the asset should match the liability side. So one way of equity is what I've told you earlier. The other way of looking at equity is asset minus liabilities. Whatever assets the company or the business has accumulated over its lifetime, as on this date, minus the liabilities which the company has to pay to others. That is what is equity. So you can now look at the constituents of equity in two ways. One is you look at the assets and the liabilities which it uses, or the other way is where there are companies, different companies, where they will use equity, like they will not just use simple equity share, but they'll also have preference shareholding. They'll issue warrant. So these are different types of ways in which you can include or increase your equity.
Okay.
Right?
Yes. Yeah. That's true. And that brings us to, often you come across companies where the market may be doing well, but the company's equity may be going down. Is it possible that a company's equity going down, but the market is reacting positively? Or in other words, to put it very simple, direct question, do you see as a investor and advisor any specific relationship between the price and the equity per share?
So as a thumb rule, generally, if a company is doing well, its equity should go up over a period of equity means I'm talking about the reserve portion. That
Yeah,
reserve will go up. Okay. That
okay.
reserves will go up. That means the equity share capital plus reserve, which we call the equity or net worth, whatever name we may use, that
Yeah.
will go up. And as it goes up, we will have more investors looking at businesses like that.
Mm-hmm.
And that is how the market realizes or looks at that kind of a business.
Mm. Okay. So you are saying that when the B goes up, the book value or equity per share goes up, there is an expectation that the price will also go up. Am I
Yes,
right? Because
this is the thumb rule where
yeah, that's right.
this is, but that
But
doesn't mean that always it is going to happen. There are times
yeah.
when an equity can actually go down
Okay.
because of the near term or the last few years losses. So there
Okay.
are heavy asset, there are many asset heavy businesses which
Yes.
may have accrued a lot of losses in the last, say, 2-3 years because of industry related issues or because of company specific issues. However, they have a lot of assets which basically gives them a liquidation value.
Mm-hmm.
Okay, even though your equity today is getting wiped out because of the losses,
Mm.
you don't have any you still have a lot of assets which still holds a lot of value for it. So let me give you an example. For example, the on the asset side you have, say, 5,000 crore of assets,
Mm-hmm.
right? But on the liability side, you
Yeah.
are heavily debted, and because of that your loan is very high, say something around 3,000, and every year you are reducing your equity because you are facing losses. So your equity is less than 2,000 crore.
Okay.
Okay. So in that kind of a scenario, the stock can still do well when
Mm.
the market realizes or when the investor group realizes that even though the equity has gone down, even though the losses are there in the company, there is a lot of asset value which a company has. And right now, the sector is turning. The, the sector was always a cyclical sector. Say, for example, a steel company, it
Yeah.
has it has faced a lot of downturn or headwinds in the last 3-4 years. But nowadays, or in the next 2-3 years, through due to the tailwind, sectoral tailwind, they will be able to sell off some of their assets
Mm.
and improve their equity that ways. And again, even though today's balance sheet may not show a positive number,
Yeah.
but the expectation of the next 2-3 years improves drastically. That is where, even though the equity is going down, you may
Yeah.
still have the stock price going up. But these are very few examples.
Okay.
And I'll just put a disclaimer here also
Mm.
that turnaround seldom turn, which is a very famous quote of Mr. Warren Buffett, wherein many of the companies which think that they will be able to turn around, out of 100 companies, probably 2 or 3 manage to actually do it.
Okay.
Right. So
Okay.
that is it.
Okay. So you mean to say that though the equity is important, but there is a possibility that even if the equity going down today, the expectations may be high because of the possibility of generating future returns. Am I right? Did I get it correct?
Yes, yes, yes.
Yeah,
Absolutely.
that's a clear explanation. So, did you come across on your in your portfolio of advisories the companies that you examine? any company whose equity has been negative consistently, but still you advise your investors to buy the shares, if at all? You don't have to name them, but did you come across such companies where equity is negative because the losses have written off or wiped off the capital? But yeah, they have a potential. Instead of naming the company, you can give us an idea with the industry. What type of industry you see that type of behavior?
Yeah. So I'll not name the company, and I'll also be a very give you an honest assessment wherein I never bought that company in my portfolio or recommended it for my clients. But this is a company which I noticed from the sidelines, which happened there. So it was into manufacturing space,
Okay.
and they had a lot of land bank. They had a lot of uh, how do I put it, plants and machineries. So the asset portion was very, very, very heavy. Okay.
Mm-hmm.
Now the only thing was that due to the situation, due to the inability of the management to, it was nothing related to industry. It was more related to the inability of management uh, to serve the business well. They had
Okay.
accumulated losses. So
Okay.
the trigger. So coming to your point, we should always look at trigger. The
Okay.
trigger for this company was that there was a management change.
Okay.
Another new company, in fact, a larger company, larger investor group, they bought out this company
Mm-hmm.
based on that. Oh, okay, even though the equity is negative, I'll buy this out because I know that the business is very good. It's just that they are not managing it efficiently, and we have the management bandwidth to
Mm-hmm.
manage it efficiently. So that stock in a 2 year period became a 15 to 20 bagger.
Okay.
The only reason was this, because overall the market was not at all happy with the company. Nobody was paying attention. And
Mm-hmm.
that is the time when management change happened and they started cleaning up the things. And over the 2 year period, you saw the price going up.
Okay. So according to you, based on your experience, you're saying that don't just always go with the balance sheet, but also see something other than the balance sheet also. So if
Yes.
that is your advice, can you please help us, and our listeners by saying, when you say then other than financial, what are those other than financials you will definitely get into when you are examining a company's position, market position?
Sure. Sure, sir. So first of all, I'll just make this thing clear. The thumb rule still stays the same, that financials are important. If a
Mm.
company over a long time is not being able to show growth in their financial, there is something inherently wrong. But there are exceptions to the rule. So I'm talking about exceptions here. Okay.
Okay.
And before going to the exceptions, or as you asked me that question, apart from financial, what is more important is the quality of business, the quality of the industry. There are some industries which are inherently uh, in a superior position to other industry. Let me give you some examples in terms of industry.
Okay.
You look at IT services and now IT product companies or even IT platform companies
Mm.
right now. They have a superior advantage. For example, if I take the case of IT platform companies, their business model is non-linear. What do I understand by non-linear?
Mm.
What do I want to say by non-linear? For incremental increase in sales, they
Mm.
have to make almost negligible incremental cost.
Okay.
Okay. That is not possible for a manufacturing company, a chemical company, or a pharma company. Because to make incremental sales, you have to invest in incremental capacity. Okay,
Yeah.
I can give you a very relevant example of a company which is not listed so that I can take its name.
Mm.
Look for Make My Trip
Yeah.
or Make My Trip, since it's a platform business,
Mm.
to go to serve one customer from one customer to say 10 lakh customer or even 1 crore customer.
Mm.
They don't have to do anything extra.
Okay.
all the expenses will remain the same, whether it is one customer or 1 crore customer. They'll hardly have to invest more in the in terms of building on their servers.
Yeah.
Okay. So that is where I would like to make you understand, or your audience understand, that equity is important, financials are important, but what is even more important is the quality of business and industry.
Mm-hmm.
And on top of that, the quality of management.
Mm-hmm.
When you have the potent combination of good business, good industry, good tailwinds, very good management, then you should be very, very, very clear that there is a higher probability that valuation of these companies will always be higher than the market average.
Okay.
That is something which I learned the hard way, spending 10 years in the industry, and then I could sense that this is what happens.
Okay. That's very relevant advice. I could see that. So don't just get dragged by or driven by the numbers alone. See something which are not there in the balance sheet also. But as we're moving towards the end of our conversation, I would like to know from you, Ankit, when you see let me come back to the financial statements. So when you see the financial statement, as an advisor, what will you tell to a potential investor? How long, that means how many years past data they should see and how many years future data they should forecast?
Sure, sir. So this is a very personal question, as in different investors have different views on this. I personally feel projection or accurate projection is not possible at all. So and you will come across different investors who do elaborate projection. I don't do projections. So how I look at it, that does. So having a DCF or discounted cash flow framework in mind and doing elaborate DCF projection, these are two completely different things. So I am someone who have a DCF framework in my mind, but I will never do an elaborate 10-year Excel forecast. And I'll tell you why.
Okay.
Number one is, now coming back to your question again, in terms of past, I would say go as far as back as possible. There are cases where 15 years, 20 years back also going, because the more you go back to the history, you get more understanding of the DNA of the company and the management. Okay. Now, there are practical implications. Sometimes it is not practically possible for you to go 15 years, 20 years back for all the companies you are studying. That's fine. Even if you can get a good hold of the company in looking at the last 3 years, 5 years statement and it works with you, that is fine. But the more farther you go in terms of looking at the history, the better it is for you to understand the company. But when it comes to future, rather than having a 10-year view of where the company will be in 10 years, we should always have a watchful attitude where we will quarterly look at the results, yearly look at the annual reports, and then make a 2 to 3 year rolling forecast. And that forecast is also a very back of the envelope forecast. It should not be an elaborate DCF model. And why I refrain from doing that is because the biggest fiction is not written on Excel, on Word, but it is written in Excel. Once you make an Excel model, you inherently imbibe or infuse your bias into that model. So rather than doing that, you focus on what the management is doing, what the management is saying, what are the other competitors in the industry doing and saying, and what is your understanding overall after listening to all of them, and make a very simplistic forecast on the next 2 to 3 years and keep it rolling every year. That is where you get a much more practical insight where the company is doing. When you make a DCF forecast for a good quality business, a DCF forecast will always find those companies extremely overvalued, and you will miss out on those.
Okay.
That is the biggest problem in DCF.
Oh, that's fair enough. That's wonderful. I think, Ankit, for the time being, we are coming to the close of our conversation, but it was wonderful listening to you, despite the fact that you are a investor advisor. You have said that persons can start immediately, get into and understand the markets on their own. Number one. Number two, despite the fact that you are a trained reader of balance sheet, user of models, you also said that it is important not just to just stick to the financials, but also see some qualitative aspects of the business. So a nice combination of analysis of the financials, analysis of the models, and understanding of the intangibles and the quality of the management is the crux of a good investor. That is what you have conveyed. We'll continue our conversation with you. Maybe in the next conversation, we would like to listen to you for the way you analyze a particular company with and without using the financials. But otherwise, it was wonderful discussing and having a chat with you. Thank you, Ankit Kanodia.
Thank you so much, sir. I also enjoyed a lot.
We look forward to more such conversation, more insights from you, a well experienced investment advisor. Thank you very much. Have a good day.
Thank you, sir.